Hello and welcome to NDTV Profit. You're joining us on The Big Story, where we are talking about the Reserve Bank of India's recent actions against non-bank financial companies as well as some other market participants who have broken RBI rules. Now, just on the 5th of March, the Reserve Bank of India issued a press release on its website citing JM Financial Products and a review that it conducted of JM Financial Products after a complaint from SEBI. The Reserve Bank of India found certain lapses at JM Financial Products in the way that they were doing their IPO financing business, their debenture financing business, and because of that, the RBI barred JM Financial from extending loans against any shares or debentures, any other such securities. A day before that, on the 4th of March, that was when the Reserve Bank of India issued another press release that was about IIFL finance, where they talked about how gold loan financing business had certain governance lapses, certain operational lapses, and that's why the RBI barred IIFL finance from going out and lending against gold. A few weeks before that, on the 31st of January, the Reserve Bank of India issued guidelines against Paytm Payments Bank, where it said that despite the RBI repeatedly going to Paytm Payments Bank and asking them to fix issues with regard to KYC at the bank had not done enough to address these concerns, and that is why the RBI would order a complete stop on any banking services provided by Paytm Payments Bank. A few weeks before that, now if you go to December, there were rules against banks investing in AIFs. There were certain guidelines issued to peer-to-peer lenders. And sometime before that, in November, the Reserve Bank of India raised risk weights on unsecured credit. Now, this is a series of actions that have happened within the banking and finance sector, with the RBI's attacking certain specific areas where concerns were developing, and then certain entities where the RBI had problems. There has been a change in the approach, because earlier the Reserve Bank of India would have probably levied a penalty, but now it seems that the RBI is more intent on putting business restrictions on these entities. To discuss this further and to answer these questions in a slightly more deep manner, I have with me Mr. Abizer Diwanji from EY. Mr. Diwanji has been a long-term commentator and an expert with regard to the banking and financial sector in India. Mr. Diwanji, welcome to this conversation, sir.
Thank you.
Let me start with my question. Is the RBI's approach changing from doing small penalties to now just completely shutting off businesses?
Well, I think from what you all explained right now, there seems to be some level of concern with respect to systemic risk. And I won't say that's completely misplaced. The level of action taken against it, going from actually stoppages of business, not that RBI has not stopped businesses before. And as long as these stoppages come with adequate warnings to improve systems, I don't think it's completely misplaced. But what seems to be the case now is, I think, this whole issue around systemic risk, especially in potentially open exposures, especially again on the consumer and SME side, the LAP side, which is kind of bordering on personal expenditure. This seems to be a little bit of a concern in RBI's mind, and they seem to have now been cracking down primarily on asset classes which are kind of difficult to value, or on the peripheries. You take shares or you take gold, there is a potential that there could be an unsecured clean portion on it, which RBI seems to be a little worried about, because they can't really gather what the momentum, what the impact would be. And of course, the other thing is, it's only primarily focused towards NBFCs as of now. It hasn't touched banks on it, because they believe banks have adequate liquidity to be able to manage the situations. NBFCs may or may not have the liquidity, because when the paranoid spreads, what will happen is that NBFCs will have liquidity issues, which they may find difficult to, and that problem is precedented. So in a sense, there is a little bit of a concern that RBI has. Whether this is an overreaction or no, time will tell. But what seems to happen is that when you stop businesses, markets react very differently. And when market reacts differently, sense of confidence in that entity goes away. And when a sense of confidence in those entities go away, you find a run on those entities. So I think the impact sometimes of business closures are large. And I would again reiterate that it would be important to publicly disclose some of the reasons, so that those reasons can be understood better by the consumers and the stakeholders, And to some extent, when the regulator puts those conditions down before issuing an order, there could be a sense of what else could be done apart from simply banning businesses. So yes, could be a bit of a drastic step, but one can't rule out the fact that there is a worry that there could be a systemic issue.
Correct. I want to tackle some of these points individually. Firstly, with regard to how the RBI is treating the non-bank finance sector, and people who are bending rules or breaking them are facing the music at this point in time. Now, for the NBFC sector itself, this is looks like a bit of a repeat, because 2018, after the IL&FS crisis, you had this situation. You had your DHFL failure, you had later Reliance Capital, Shire, all of these cases you're intimately familiar with. But I'm just trying to understand, will this then lead to that kind of a fallout where you eventually have certain players who just are not able to deal with the pressure?
No, so I think the cases that you just mentioned were also cases where there were apparent frauds, and those the balance sheets were being stuck around despite those frauds happening in those entities.
Yeah.
And there are liquidity mismatches in those businesses. There were frauds and there were liquidity mismatches. And when banking finance kind of slid away from NBFCs post IL&FS, they were not able to meet those liquidity mismatches. So that I think that was a different problem. The problem that we're dealing now is that of a systemic risk coming out of retail, where a lot of people have grown their balance sheets significantly over time and have slid from secured lending to retail lending in a fashion, because the banking system has moved into more secured lending.
Correct.
So from cost of funds perspective, NBFCs have slid to a slightly, as you can say, subprime lending. And there is a concern emerging out of that are we looking at systemic risk sitting in that business? But as I said, there could be a potential systemic risk, and one has to appreciate the regulator's concern for that. At the same time, one has to make sure that stopping of businesses could have a ripple effect, and that ripple effect could would want to stop. Very frankly, Howard Marks has said that economists are people who do not have mark-to-market responsibilities. I guess that could be said for regulators too.
So, okay, fair enough. I think the last time around, the criticism that the RBI sort of took on was the fact that it was maybe a little too late in acting with regard to the problems that were emerging. So now they are acting even before the problem becomes, or the problem is recognized as a real problem. I mean, yes, it's an issue, but is it a problem? I wanted to get your thoughts on this. Is this preemptive? As you said, ripple effects do follow once you take actions like this. But is this approach a good approach for a regulator to have? Or do you think maybe the system should have some room to make mistakes?
Obviously, it depends. We don't really know the facts. So to what extent has the Reserve Bank kind of given them enough warnings and given them enough ability to change? And then is this drastic step taken as a result of a non-compliance of an aggressive nature? If that be the case, then I think those actions would be justified. Frankly, I'm not privy to what the real problems of these companies are.
Sure.
But yeah, fundamentally, I would think that stoppages of businesses would have been. I mean, RBI would have taken that decision only when after they've tried every other method. And of course, then there is the more expensive method of the administration process. And I think that would be a far more drastic measure to take. And RBI always has been trying to avoid those drastic measures because those destabilize organizations and sometimes lose value. So now what they're saying is, okay, you may have a temporary blip in your business stability, but as long as RBI believes that situations can come around. Now, situations like Paytm Bank, for example, RBI said, sorry, we're not giving you a chance to turn around at all. And we want you to shut down on a particular date because we've given enough warnings to you. So that could be a different level of dissatisfaction the regulator may have with the process. And that's why they could have taken those actions. So I think here, while it is drastic and it has issues that could have potential ripple effect issues, I think it would not impact these organizations that drastically, because these organizations are fairly well capitalized and fairly well liquid. In the short run, there would be an impact because markets would panic. But I think their ability to come back would also be quite high. So I think RBI has not kind of spelled doomsday for the recent two ones, and for Paytm it has. And as far as the AIF issue that you raised was concerned, I think that was clearly a systemic issue. In a sense, that some of the NBFCs were actually pushing on credit to AIFs and taking junior structures, which are actually NPLs, and the mark to market of them was nothing. However, that had another effect, which maybe was not taken care of, is that people make banks and financial institutions make genuine investments in AIF, and those were not carved out. So ideally, I think these kind of fraud monitoring or systemic risk type issues are causes for horses, and I think rather than regulation, a better way to tackle it would be through specific inspection. And that's what they have done in the case of JM and IIF. They've not changed regulation. They've simply said, fix yourself and then continue doing the business. That didn't happen with the AIFs because this came out of the regulation. And as far as Paytm is concerned, they were as drastic as saying that please shut the operations after a particular deadline. So the RBI is also calibrated depending on what they believe the problem is. But yes, we've seen too many too quickly, and hence one believes that
that's where I think that's where this conversation is emanating from. Is the back-to-back nature of it that was a little worrying. Okay, I want to take the last question with you. You mentioned the point about the RBI should be a little more transparent with explaining the reasons as to why they are announcing these restrictions on the businesses of these companies. Historically, what has been maintained is that if we put out everything in the public domain, it may cause confusion, it may cause runs, and that's probably not what the RBI wants from a financial sector stability point of view. But do we have a market that's far more mature, far more informed to be able to look at a regulator's findings and then say, okay, this is clearly a problem and that's why this happened?
So I think corporates can manage their COPCOM better if RBI actually came out with reasons.
Yeah.
Because they could take those reasons and give specific answers.
Of course.
Rather than have complete bans. SEBI does that very effectively. And I think international regulators also do that. So I think it may be a good practice to do. Maybe what to disclose would be left to the regulators' discretion, which I'm sure they will use well. But what happens more, Vishay, is that sometimes when you're penning down the reasons why you want to take specific action, and when you pen down those reasons, you may rethink the actions that you're proposing to take. And that would help everybody.
Point of reflection, yeah. All right, Mr. Diwanji, thank you so much for talking to us. As always, it's a pleasure talking to you. And for our viewers, please do continue watching NDTV Profit.